Downer said the store staff appeared to be overwhelmed by the chaos of the day. One Instagram user described the store's condition as the zombie apocalypse.
Are you ready to make the most of the only life you have? To make smart money choices focused on achieving what you care about most? Here to help you balance living well today without sacrificing your tomorrow is the retirement answer man, Roger Whitney.
Every Friday after Thanksgiving is Black Friday, right? The big shopping day of the year, evidently. And my wife and her mom and her sister, love to go shopping on Black Friday. I have no interest in doing that at all. Usually the kids and I would go see a parade, maybe even we go see a movie and spend some time together. But Black Friday is a time in America pop culture anyway, where everybody just runs to the stores to find these great deals. And it can be pretty crazy scenes. Go to YouTube and Google it. You'll see just these massive crowds waiting outside the door of a Best Buy or a Nike. And as soon as those doors open, there literally have been people trampled from people rushing in all at the same time to try to get the same deals. Well, I came across this news story about a Nike store in Seattle last year in 2016, where the store was completely trashed. And they have some photos on it showing all these orange boxes, these Nike boxes, just all over the place, along with shoes thrown left and right. A Nike store customer, Larry Downer, had told BuzzFeed News he and his son went there to get some basketball shoes, and he said it was unreal. He said, we started walking through from aisle to aisle, and you're walking over orange boxes everywhere. People were just kicking the stuff out of the way. At the end of the article, a store worker who wished to remain anonymous said an estimated 20,000 people passed through the store between 8 p.m. Thursday and 10 p.m. Friday. 20,000 people all rushing to a Nike store all at the same time to try to get a deal. That sounds insane, doesn't it? It shows you the madness of crowds and what can happen, and that's going to make more sense when we get to the hot topic story right after this disclaimer. It's time for that all-important disclaimer. Hey, real quick, don't take advice from me on the show. I only give advice to clients that I work for and with as a fiduciary. I don't know you. You don't know that much about me, so think of this as helpful hints and education, and talk to your legal advisor, your tax advisor, or your financial advisor, because that's just common sense. Now, in today's show, we're going to be talking about indexes. Now, realize you cannot invest directly in an index. It's just a hypothetical portfolio model. And we're going to be talking about mutual funds that mimic indexes. Now, realize past performance is no guarantee of future results. Yeah, really. And that different types of investments have different types of risk, and you need to understand those and read the prospectus before you do anything, because that's just common sense too. Now let's get to the hot topic of the day. So in the news today, it appears that passive investment management has taken over the world. Now, 9 of the top 10 largest mutual funds are based off of passive investment management. That's not necessarily a bad thing. It's estimated that about 70% of the volume of U.S. equities is accounted for by passive investment strategies. So that begs the question, what exactly is a passive investment when you come to portfolio management, especially stocks? We're going to talk about equity management today. So passive investment management aims to maximize returns by using a buy and hold strategy, meaning to keep the amount of buying and selling to a minimum. And this accomplishes 2 pretty important things. First off, it allows the strategy to have substantially lower expenses because you're not paying a portfolio manager, you're not paying analysts to go research companies, you're not paying traders to actively trade the account, you're not paying economists and forecasters to do research and make predictions. You're just trying to track some hypothetical portfolio in a investment strategy wrapper. So the fees are substantially lower typically, which is its main advantage. And then secondly, it can be more tax efficient potentially because there's a lot less trading going on. So that's basically what a passive investment is, or passive investment strategy. So if that's what it is, it's just about finding a hypothetical portfolio and mimicking it and just holding on so you can have low fees and low turnover. The next question is, okay, what hypothetical portfolio is a passive investment trying to model, right? Because they have to pick one to try to just buy and hold because they're not thinking of them all by themselves. So what has happened as this passive investment management craze has grown, they have settled on, it seems, 2 indexes to try to model. If you look at the top 10 largest mutual funds, 8 of the top 10 are focused on 1 or 2 strategies, either the Standard & Poor's 500 index or the total market index. An index, refresher course here, an index is a hypothetical model, portfolio model created by somebody. Standard & Poor's created and manages the model for the S&P 500. So what it does is it comes out and says, based on our methodology, this is what the portfolio should be. It should be these 500 stocks in these proportions. So when they announce that, anybody that's trying to replicate that as an investment strategy, their goal is to track it as closely as possible. They want low tracking error. And then the total market index is similar. When they come out with what the total market index is, any passive investment that is saying, I want to follow that, they will buy it and hold it and try to lower the tracking error. That's basically what most passive investments, at least in the equity space, have chosen to do. They're at least the most popular. It doesn't mean it has to be that way. A passive investment can actually track anything that it wants. It just so happens that through the evolution of passive investment management, tracking the total market index or tracking the S&P 500 have become the dominant ones that everybody just buys. So when I say when everybody just buys them, what do I mean by that? In those 2 categories or 2 funds tracking those indexes, the total market index or the S&P 500, those 8 funds within the top 10, they manage a total of $1.3 trillion. That's a lot of money. That is how much money has flown into these 2 particular indexes. Now, if we accept that passive investing makes sense because of substantially lower fees and a lot less turnover, so more potential of tax efficiency, the next question is, what passive investment strategies make the most sense for us? Well, it seems everybody's voted with their dollars and said these 2 indexes. So let's look at these 2 indexes that are the most popularly tracked indexes for passive investment management. First, we have the total market index, which has a goal of trying to replicate the total U.S. stock market index. It's really trying to get a big swath of the U.S. stock market represented in this one index. As a result, it has 3,600 different individual stocks within the index, a little over that actually. So its goal is to try to provide exposure to the entire U.S. equity market. Well, it seems like it would if it has 3,600 different equities in it. But if you look at the holdings of a passive investment or the index, the total market index that is tracked, the top 10 holdings of the 3,600 represent 15% of the portfolio. The top 25 holdings, 25 stocks out of the 3,600 in the index, represents about 23.5% of the entire portfolio because of how the index is structured. So you may own 3,600 individual equities, but about almost a quarter of every dollar going in is going into 25 stocks. Now, if you look at the diversification, because it's supposed to get the total U.S. stock market, 70% of the total market index is either in large or giant companies, as defined by the market capitalization. So 70% of the investments are all going into basically giant or large companies. Now, if we look at the S&P 500, which by far is the largest in terms of monies invested passive investment strategy, this is what the largest ones track. The top 10 companies in the 500 company index represent about 19% of the portfolio. And the top 25 holdings represent a little over a third of the entire portfolio. And if you combine giant and large companies, if you buy the S&P 500, about 86% of the portfolio is in what's considered giant or large companies. Now, that may not be particularly bad. The question is, though, when you have 8 of the top 10 largest passive-based investment strategies all focused on going into basically the same thing or something very similar, and those individual indexes that those strategies are based off of are very focused on a much smaller segment of the market than it initially appears, is that an efficient way for you to implement a passive investment strategy? It may be, but it might not. Some things to consider. These two particular indexes that are the two primary indexes that are tracked by domestic U.S. passive investments, they are cap weighted. And we've talked about some of this stuff before, but I think it's good to have it all in one place. Cap weighted means that the more influential, the larger the company is in the index, the more influence it has on the overall index. That's one reason why you see so much concentration in the top few holdings, because those companies are so much bigger than all the rest of the companies. And as they get bigger, more dollars go into them. So it feeds on itself a little bit. Think of everybody rushing to the same spot at the same time. Another thing to understand about these two particular indexes and passive investments based off of them is that these indexes are rebalanced at fixed dates. As an example, the S&P 500 index rebalances on March, this is for 2017, March 17th, June 16th, and December 15th. So on those 3 dates throughout the year, the company, Standard & Poor's, comes out with, this is what the allocation to the index should be. These are the company stocks that we are adding. These are the company stocks that we are deleting, and this is the rejiggered allocation to each one of those companies based on their methodology. So you have 3 dates a year when the S&P 500 is reconstituted. On those 3 days, any passive investment that is basing their portfolio off of the Standard & Poor's 500 index is going to move as quickly as possible to mimic its index as quickly as possible, because their goal is to have a very small tracking ratio relative to the index that they're trying to be passive to. Well, when you have all of this money going into the S&P 500, in this instance, and on 3 days a year, it rejiggers what the portfolio should look like, you have everybody running in the same exact place at the same exact time, selling what got dropped from the index, buying what got added to the index, and rejiggering the allocation based on what Standard & Poor's says. Imagine that Nike store. Everybody running in at the same time, trying to grab their share so they can track the index, and then running back out of selling the ones that got dropped from the index. That's a lot of volume going around. In fact, studies have shown that around these rebalancing times, there's big disruptions in the market because all of this mass amount of money in this case, the S&P 500, are all running to the same place, and they can't be very intelligent about it because their mandate is to track it as closely as possible. So I find this really interesting when you look at the amount of money going into two indexes where they are graded by tracking error. So they're all moving in this huge swarm, and everybody just keeps piling money into it. That works on the upside as money keeps going into it. But what happens when people start selling it and everybody is rushing the other direction? There's this false sense of liquidity, meaning that, oh yeah, it's so liquid, it trades so much, I can get out anytime I want. That is true unless everybody is trying to do it at the same time. Now, it's not going to all happen at the same time. But let's go back to the main question. If the main advantage of passive investing is some tax efficiency, getting a very diversified portfolio very quickly, but primarily lowering of fees substantially, there's nothing that says having a passive investment has to track one of the most popular indexes. And that what you track doesn't have to be cap weighted, doesn't have to be blindly, it's called dumb beta, doesn't have to be blindly reallocated on specific days. There are more intelligent ways potentially to be able to do this. So I am a fan of passive investing because I love controlling fees when investing for clients. What I worry about and what I wonder is there a more thoughtful way of being a passive investor so you can avoid some of these crowds, this huge crowd in two particular indexes, or mimicking two particular indexes, in order to have a little bit smoother ride and possibly add value from an overall investment allocation standpoint? I think there is, and we'll be talking about them in upcoming episodes, but I want to just put this into your head. That, when you think about passive investing, understand it's not necessarily tracking the most popular index. It's about controlling fees and being a buy and hold investor, and there could be more thoughtful ways to do that. Now let's get on to some listener questions. Well, welcome to the Practical Planning segment where we're going to answer some listener questions today. We haven't done that in a while, and I apologize for that. We've been doing lots of, cool series, but I want to make sure that we're answering your question. So our first question comes from Joey, and it's related to index-based investing. Joey, that's one reason why I picked the topic and went down a little rabbit hole in the hot topic segment. So let me go through your question. Well, really your questions, because it's a multi-pronged question. He said, first he asked about the total market index, whether that would help solve the problem. And I think I answered that in the hot topic question. You still have some of the structural inefficiencies, in my opinion, by using something replicating the total market index. Then you next ask, what about the equal weight S&P 500 index? So what does that mean? So an equal rate index basically says, okay, we're going to be very similar to the S&P 500 index, but rather than give more influence to the larger companies, we'll just take every dollar invested and divide it equally between all 500 companies. That way you avoid some of the concentration risk of having so much money in just the largest companies in the index. So, Joey, that can definitely go part of the way, right? Because you're going to have, obviously, very broad exposure. You're going to be in 500 different companies at the same levels. One of the issues you can run into, though, is you're going to be a lot more weighted to smaller cap, which is historically more volatile. And you're going to treat every company differently in that the most profitable, well-run companies will be treated exactly the same as some of the companies that may be on the bubble or may be very unprofitable, even though they're still part of the S&P 500 index. So it still isn't super smart in terms of it's not thinking through what it's actually owning in that sense, but it definitely will give you much broader exposure. Generally, I'm not a huge fan of those. Lastly, Joey says, I appreciate your perspective and would agree that some of the risks you alluded to regarding the flows of money, that those are somewhat unavoidable to a large extent, even to active managers, since such a large piece of the equity market is index-based in securities. You're correct to an extent. And again, I think the question isn't active versus passive. You can still be passive, but still have a much broader diversification than normal passive investment based off of the popular indexes. And you can also still have some wisdom applied to how that portfolio is constructed, focused on more than just simply how large the company is. And we'll talk about that in another episode. But yeah, you're always going to have exposure to the flows, but there can be, in my opinion, more intelligent ways of implementing a passive portfolio. Now, the next question actually just came out of the blue, and it wasn't really from a listener. It was from someone that got themselves into a jam, and they weren't sure what to do about it, so I had to do some research to see what they could do, and it wasn't really much. So here's what happened. I get contacted. We'll call this person Karen. And Karen worked at an employer, and she had taken out a 401k loan So she borrowed against her 401k and was making regular payments back. And then the company switched her from a W-2 employee to basically an independent contractor where she was paid, and it was a 1099. And it was a structural thing to give her some more freedom. Well, she had this 401k loan that from the employer. So what happens when you have a 401k loan? In her mind, it was, I'm really still working at the same company. It's just a different structure and I have some more freedom. But unfortunately, technically, no, you're separated from service from that company as an employee, and certain things kick in regards to a loan against a 401k. Because if you quit your company or you leave your company, the loan must be paid back right away, usually within 60 days of termination of employment. If you can't repay the loan, or if you don't repay the loan, it's considered in default, and you will be taxed on the outstanding balance of the loan, including an early withdrawal penalty. This is assuming you're under 59 and a half. So in this instance, it felt like she didn't make any changes in employment, but technically she did, because she went from a W-2 employee to an independent contractor. Basically, she had her own business. And so this loan outstanding, and she didn't realize it till well after the fact, and now it looks like that the balance of that loan is going to be treated as a early distribution, and she's going to have some significant tax implications. So obviously she needs to talk to a tax advisor, because I am not one. But I thought it was an important thing that we talk about here, because if you have a loan against your 401k, you want to be very careful if you're nearing retirement or you're going to be leaving the employer in the next couple of years, because that loan could be a little time bomb that you're going to have to try to take care of. So our next question comes from Rich, and it's related to asset placement. So he says he's a few years away from retirement, and he has always put all of his fixed income or bond investments in tax-deferred accounts, and all of his stocks or equity investments in taxable accounts in order to be very tax efficient, because bonds pay interest, which is taxed at a higher rate than qualified dividends and capital gains. So now he's finding himself a few years from retirement, and he has all his risky investments in his taxable assets, and all of his more stable investments, his bond investments, in his tax-deferred accounts. And even though overall the mix is about 60% stocks and 40% bonds, he says. And Rich says, in working briefly with a CFP and doing asset allocation simulations, all the results were far off. The CFP said that it was due to having too many risky assets in taxable accounts and too many low-risk investments in the tax-deferred accounts. He says that may work from a tax strategy, but it doesn't really work in retirement, because the typical process is to withdraw all your taxable assets first to postpone deferral as long as possible, or allow deferral to happen as long as possible. So Rich is wondering, hey man, I'm a few years from retirement. I got sizable balances in my taxable accounts and my tax-deferred accounts. Should I be adjusting this now? That's a great question, Rich, because you did something that may have been prudent at the time. In my work to get my certified private wealth advisor, we did case studies on high net worth individuals and talked about asset placement. And indeed, the studies that we went through showed that this kind of asset placement can have a big benefit from a tax perspective if the numbers we're dealing with are large enough. But you do run into what you're talking about, because the typical methodology and retirement is that you drain your taxable investments first in order to minimize the income coming out of tax-deferred accounts. In your case, that means you got risky investments. So what happens when the markets are down? Where do you get cash? So it's going to be really important for you, most likely, to have ample cash reserves to meet the cash flow needs that you're going to have, and that's all going to be dependent on your situation. Because if you don't have ample cash reserves, and you need to go to your investment assets to access money for your lifestyle, it's going to be selling equities. And if you have a big market downturn or drawdown, when you need to refill your cash buckets, you may have to sell at distressed prices in order to raise the money for your life. That may be decision number one. Or if you go to your tax deferred account, so you can access your safe, less volatile assets, now you just create a different tax problem because you're taking money out of a tax deferred account and realizing it as income. Where I've come to on this, Rich, is in my experience, unless the numbers are really large, the tax efficiency you gain from such drastic asset placement can be negated through the issues you have in rebalancing, because it's much harder to rebalance when you have asset placement like this. And then in retirement, and as you get close to retirement, it makes it even harder to make it an efficient portfolio when you're starting to withdraw assets. So it may have worked for a very long time in the accumulation phase, but you may want to consider starting to readjust some of your portfolio to target account by account the timeline of those investment assets. So you want to do that in the most tax efficient way as possible, but I think it will generally help you if you have a more balanced approach in your taxable investment account rather than just simply all equities. Generally, the way I like to manage assets is, not generally, this is how I like to manage assets, is each account has its own risk return profile or asset allocation, account by account. Whether there's 3 taxable accounts, each one will have its own allocation based on the timeline or the time frame for its investment horizon. And then we want to be as efficient as we can in implementing the portfolio. So, okay, if you have bonds in a taxable account, you don't have to buy taxable bonds. You can buy tax-free bonds that give you a tax benefit, number one. And number two, if you're aware of where you're at from a capital gain standpoint, you can be a little bit proactive through a few different strategies of trying to neutralize taxes year by year, even when you're rebalancing. So I'm not a big fan of hard rebalancing. I like to be aware of the tax situation so you can try to neutralize it as much as possible. So in your situation, I'll say one last thing here, Rich, is if you don't want to rejigger the portfolios and you want to keep all the equities in the taxable account, maybe it's because you have so much capital gains that you're going to have taxable issues there. If you're a couple of years out from retirement, maybe you build up higher than normal cash reserves so you can have a bigger cushion in the event of bad equity markets. And then you start to adjust your portfolio on the equity side to be throwing off more dividends than maybe it has historically. So you can have this good tailwind to help you be more strategic on when you have to actually go touch those assets. So that might be something that you can do. Okay, our last question comes from Mary Ann, and she wants to know about investments versus paying off credit card debt. Okay, so Mary Ann says, I'm 55. I'm newly divorced, and I have a 13-year-old daughter. I have approximately $25,000 in 3 retirement accounts. I have been left with about $33,000 in credit card debt, with over $400 a month in interest charges on this debt. Should I empty my retirement accounts to pay the credit cards? I am self-employed and make about $30,000 a year. Hey, Marianne, first off, I am so sorry that you're having to deal with this, being divorced with a 13-year-old and being saddled with this debt. So sorry that you're having to deal with that. Obviously, I can't give you specific answers in a forum such as this. So I do want to encourage you, go to rogerwhitney.com, click on Contact Roger, and let's you and I just have a conversation in private, and I'll do my best to guide you any way I can. When I look at your situation, do I take money from my tax-deferred accounts to pay off credit card debt so I can decrease the interest charges? My first inclination when I see a situation like this is, okay, well, positive cash flow really solves a lot of problems. And you're self-employed, so you may have some more levers to pull than many people. So the first question is, and I can't stress this enough, how do you focus on increasing your income? Because that can be the key to a lot of the strain and the problems that you're having right now from a financial perspective. That could be marketing your self-employed services better. It could be doing more of it more efficiently. It could be doing side hustles. It could be driving an Uber car. What can you do to increase the cash flow so you can get into a neutral or cash flow positive position? Because that's going to start to give you some breathing room and I imagine relieve a lot of stress. So it may be painful right now, and you may need to grow in ways that you haven't grown before, but you can do it. I've seen it time and time again. The question is, what are little incremental steps you can do to increase your income right now? And I'm happy to help you think through some of that. The reason I think you should start there rather than emptying the IRAs is because, one, if you empty the IRAs, you're going to have some tax consequence, and you're going to want to have a CPA look at that so you understand clearly what they are at the front end. You're going to have some tax consequence. You're going to empty those accounts so you won't have that money anymore. And if you haven't fixed the cash flow problem, the income versus expenses problem, I would hate for you to empty those accounts and see the credit cards or debt go up right afterwards, which I've seen happen time and time again. So I think take a little time before you make a decision like that and focus on what you can do to increase your cash flow situation before you go access that. If you're willing to have a private conversation, I'll be happy to guide you in more detail than a podcast. So just go to rogerwhitney.com and click on Contact Roger, and I'll see if I can help guide you a little bit.
On your marks, get set.
Hey, welcome to the Smart Sprint segment, where we take small incremental steps within 7 days to work to create a great retirement. So here is your assignment over the next 7 days. And I challenge you to do this one. This is an important one. I want you to go to rogerwhitney.com and I want you to ask a question. You can do it in audio form. You can do it in text, but we're going to start being more focused on answering listener questions. And I got a lot of questions in the hopper, but I want to hear a question that you've either been afraid to ask, you've been avoiding asking, or you've just been wondering and you want to get someone's perspective. So go to rogerwhitney.com, click on Ask a Question, and ask a question that you're struggling with on your journey to creating a great retirement. Hey, welcome to the Happy Lab, where each week we noodle on how to live a happier life in some way. So you may or may not know, about 4 or 5 months ago, I started blogging again, writing a weekly blog on Monday mornings. And I had a gentleman helping me, and they were based off a lot of the topics we always talk about. And they were very well written and structured. In fact, if in the blogging world, they were sort of the template of how blogging should be done. Compelling headline, bullet points, lesson at the end, call to action. In the blogging world, there's this whole science behind how you write a blog. But you know what? It never felt like me. It never was comfortable. I never felt like it was how I want to write it or how I want to read it. So a week or so ago, I rejiggered, if that's a word, my blog. So now I'm coming out with a much shorter blog on Fridays and Mondays that are a lot shorter, probably a lot less well-written, that are just thoughts on the passing scene on investing, wealth management, planning a great retirement, that are 100% me. So they're probably going to be there might be some spelling in there. I still got Nicole doing editing on it, but they're going to be a lot more authentic, and maybe they'll resonate with you, but they're a great place to share your comments and your thoughts and have discussions, not just with me, but with other listeners and readers as well. So go check out rogerwhitney.com at the blog and tell me what you think. But I guess the point from a happier standpoint is, do what's right for you. It's easy to try to do what is the best practice or what is expected of you. But ultimately, it's your life. Live it the way you want. Well, thanks for joining me on the show today. Now, if you are looking for help in creating a roadmap towards retirement and possibly managing your assets and help you walking that journey, I am currently accepting clients. Just go to rogerwhitney.com, click on Work with Roger, and we can set up a time to have a quick chat to see if it's right for you. Thank you so much for joining me on today's show.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.